Welcome to this special MPC broadcast. South African Reserve Bank Governor Lesetja Kganyago is this afternoon making public the outcomes of the bank's Monetary Policy Committee meeting in Pretoria. Let's take you live to that.
Remain muted. The longer-term economic outlook is, however, clouded by persistent risks to the inflation trajectory, the negative effects of climate change, and ongoing geopolitical tensions. In the developing world, financing conditions are expected to remain tight and growth modest. While goods price inflation has eased in much of the world, core inflation remains elevated and oil prices have increased significantly, keeping consumer price inflation from falling further. Globally, monetary policy is likely to remain focused on ensuring that inflation continues to retreat. We expect markets in major financial centers to remain volatile. Across major advanced economies, growth remains stronger in the United States than in Europe. Higher for longer policy rates and extended fiscal positions are expected to weigh on growth prospects for some time. China's growth performance is expected to remain modest, with little benefit to commodity prices. Taking these and other factors into account, the SARB's forecast for global growth in 2023 is broadly unchanged at 2.6% and remains at 2.7% in 2024. Despite considerable reprieve in the winter months, South Africa's electricity load shedding has increased and prices for commodity exports continue to weaken. In the near term, stronger El Niño conditions threaten the agricultural outlook, while global climatic events present additional risks. Energy and logistical constraints remain binding on the growth outlook, limiting economic activity and increasing costs. From a demand perspective, spending by firms, households, public corporations, and general government remains positive in real terms on an annual basis. Disposable income of households continues to grow in the forecast, albeit slowly. Debt service costs of households have increased to about 8.4% of disposable income, close to the average for the past decade. Although growth in credit extension to households and corporations has slowed in recent months, it has increased in real terms compared to last year. The forecast for investment for this year is revised up to 7.7%. These supply and demand trends enabled an upward revision to the bank's forecast for GDP growth to 0.7% from the July figure of 0.4%. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1% and 1.1% respectively. While households and firms exhibit some resilience, economic growth has been volatile and highly sensitive to new shocks. An improvement in logistics and a sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. Turning to inflation prospects, our current growth forecast leaves the output gap marginally positive, implying little pressure on inflation from GDP growth. Oil prices have increased in recent months and commodity export prices have moderated further. South Africa's external financing needs will increase as the current account deficit expands from a forecasted 2% of GDP this year to 3% of GDP in 2024 and to 3.4% of GDP in 2025. Sharply lower tax revenue, higher employee compensation, and ongoing financing needs of state-owned enterprises are expected to keep the long-term cost of borrowing elevated. Despite the forecasted moderation of inflation, long-term bond yields currently trade around 12.6%. The rand has weakened over the past year, depreciating by about 10% year to date against the US dollar, and is showing high volatility in response to risk-on and risk-off episodes. The implied starting point for the rand forecast is 18 rands 45 to the US dollar, compared with 18 rands 13 at the time of the previous meeting. The trajectory of South Africa's headline inflation rate has been shaped primarily by fuel and food prices. Compared to the previous meeting, fuel price inflation is significantly higher at 0.4% in 2023, rising to 5.8% in 2024. Our food price inflation forecast for 2023 remains high and largely unchanged at 10.4%. The forecast for 2024 remains unchanged at 5.2%. Better monthly outcomes have led to a downward revision in our forecast for core inflation to 4.9% in 2023 and to 4.7% in 2024. The core inflation forecast for 2025 remains at 4.5%. Services inflation is expected to come in at 4.4%, primarily a result of lower public transport inflation outcomes. Core goods inflation remains elevated and is revised slightly up for this year to 6.3%. Growth in average salaries and unit labor costs is lower in 2023 and 2024. In 2025, salaries are slightly higher. With services inflation lower in the near term, headline inflation for 2023 is revised down to 5.9%. The headline inflation forecast for 2023-24 increases slightly to 5.1% before stabilizing at 4.5% in 2025. Risks to the inflation outlook are assessed to the upside. At a global level, headline inflation continues to moderate, but food price inflation remains high. Oil markets have tightened significantly, and core inflation looks sticky. Despite recent easing in some food price components, domestic food price inflation was still elevated at 8% in August, and the risk of drier weather conditions in coming months has increased. We expect food price inflation to moderate further in the near term, but with high risk that it picks up later in 2024. In the absence of sustained increases in energy supply, energy prices continue to present clear inflation risks. Load shedding and logistics constraints may also have broader effects on the cost of doing business and the cost of living. Given uncertain fuel and food price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation implies that average interest rates in major economies will remain high. As a result, tighter global financial conditions are likely to persist, raising the risk profile of economies needing foreign capital. Higher inflation has generally resulted in elevated inflation expectations across businesses and households. The Bureau for Economic Research survey released in September shows average inflation expectations lower at 6.1% for 2023. The committee, however, would prefer to see expectations anchored at the midpoint of the target range. Expectations for inflation in 2023, based on market surveys, are currently 5.8%, and near-term break-even rates have increased to around 5.1%. Longer-term market expectations for inflation remain elevated. Headline inflation returned to below the upper end of the inflation target range in June. In coming months, we expect headline inflation to rise somewhat before sustainably reverting to the midpoint of the target range in 2025. Against this backdrop, the MPC decided to keep the repurchase rate at its current level of 8.25% per year. 3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant and stands ready to act should risks begin to materialize. Decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The inflation and repo rate projections from the updated QPM remain a broad policy guide, changing from meeting to meeting in response to new data and risks. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. Guiding inflation back towards the midpoint of the target band reduces the economic cost of high inflation and will achieve lower interest rates in the future. Since early 2020, the committee has recommended additional means of lowering inflation that are within the reach of the public sector, including achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping real wage growth in line with productivity gains. Such steps would strengthen monetary policy effectiveness and its transmission to the broader economy. That concludes our statement, and we would now turn to questions. And as usual, please identify yourself and the media house that you represent, and the microphone will come to you.
Good afternoon, Governor Kopano Gumbi from Reuters, and good afternoon, Deputy Governors. Are you comfortable with not just the direction of disinflation, but the pace of it? Is it enough to suggest to the committee that rate cuts would be likely in the first quarter of 2024? I know you've touched on your role in fighting down supply-side inflation before, but I wanted to ask if there's a fresh take on how the committee is thinking of tackling it, given the persistent upside risks that are currently presenting themselves. And then lastly, you say there's serious risks to the inflation outlook. Which of those are your biggest concern?
Good day, Governor, and the rest of the committee. My name is Ntando Tsukwana from Bloomberg. Governor, would you say that interest rates have peaked, and when do you think South African borrowers can expect lower interest rates? And is the SARB concerned at all by oil prices heading over $100 and staying there for some time? And how are you factoring that into forecasts?
None. Okay. Thank you very much. Direction and pace of inflation, direction definitely, pace not. Inflation initially declined at a very pedestrian pace, and over the last two prints prior to the August one, there was a significant move. The move from 5.4 to 4.7 was a significant move, and the move from the 5 point something to 5.4 was also a significant move. What does this tell us? It tells us that the job of tackling inflation is not yet done. You had identified the take of the MPC of the supply shocks to inflation and whether there is fresh thinking. The answer is there isn't fresh thinking. When you have one supply shock, you can just easily just see through it. When it is a multiplicity of shocks, it starts to fit quicker than normal into other prices, and as such, the central bank would have to respond to those. Which ones of the risks to the inflation outlook do we consider the most important? We have not attached any weight to the risks. We've talked about the exchange rate, we have talked about the oil price, we have talked about food prices remaining sticky, and all of those stuff. They are all important, and the problem here is that data moves around quite a bit and makes it very difficult in the assessment of the take on the direction of the risks. And that is why we have highlighted that these risks remain, and that should we see them materialize, we stand ready to act. Ntando, you ask, have the rates peaked and when can borrowers expect relief? Well, should we maybe ask the question, when could savers be rewarded more? Because you see, the problem with your question suggests that only borrowers in this economy matter. What the interest rate does is to equilibrate the supply and demand of savings and borrowing in the economy. Our focus is not on what borrowers want or what savers want, but our focus is attaining price stability. And in attaining price stability, we would ask ourselves the questions and the interactions between those two important actors, and of course the rest of agents which are determining prices in the economy. But you seem to have been answering your next question, which says that how do we take account of, are we concerned about the oil price hitting $100? Well, if that was to happen, it could actually become inflationary, which means that we have got to be able to assess whether this leads to second round effects, and if it does, then we would have to react to the second round effects. But once again, the problem is that you are not having one supply shock. You are having a multiplicity of supply shocks, and you have got to be able to take your decision on what those means for the price formation process. It took a long time for inflation to come down, and when it was coming down, it was moving at 0.1, 0.2. It's only in the reading of July and June where we saw significant moves in inflation downwards. And as I had cautioned before, the arrival of one swallow does not mean that summer is here. You need to see a little bit more swallows in the sky, then you will know the summer is here. And as we had seen, the July reading was 4.7%, and the August reading was 4.8%. And we expect that the September and October readings might be higher, and we have got to take this as it goes. Any further questions?
Governor Alistair Ball from Bloomberg. Thanks very much, and I enjoyed the summer analogy. You held rates and you've raised your growth forecast, but real interest rates have risen significantly, really, over the last sort of 7 or 8 months. Do you think the South African economy can handle this increase in real interest rates, which is tightening, making your policy more restrictive? And given the weakness we saw in the retail sales and the weakness coming through in the consumer part of the economy, by holding rates high and maintaining that restrictive policy, do you risk tipping the South African economy into recession? Thank you.
Is that the last question? Somebody online?
Yes, Governor, we have a question from Hilary Joffe, who's asking, is the Governor still keen to move the inflation target down to 3%?
Is that the only one?
That's the only one, Governor.
Hi, Governor. Stembile Cele from Bloomberg News. Are the fiscal risks rather outlined by Treasury, such as a bigger budget deficit for the current financial year, as well as lower revenues, of concern to the bank, and are they likely to have any implications for monetary policy? Thank you very much.
Zianda?
Governor, I have 2 questions. One is from Tuleto at Business Day. When will we see the total increase of rate hikes in the ecosystem? As we have heard, monetary policy transmission mechanism works with a lag. Is the continuous restrictive monetary policy stance not too dangerous for the economy? When will we see a cut in rates? Then,
can you repeat the first part of that question?
When will we see the total increase of rate hikes in the ecosystem?
Total increase of rate hikes in the ecosystem. Okay. Okay.
And then the second question is from Atwell Dlamini at Alliance News. The MPC notes credit growth to households and corporates, but commercial banks are reporting an increase in non-performant loans due in part to high interest rates. How serious are bad loans? Does the increase on non-performance loans worry you?
Okay. Fundi, you are going to answer the stuff about non-performing loans. That's what you look at closely. Okay, let's deal with this. Now, Alistair, real rates that gone up, you said, in the past few months, and to the extent that since the July meeting, since the May meeting to this meeting, that the real rates had gone up, is not because the Reserve Bank did anything. It's because the effect of the policy is starting to be felt and inflation is declining, combined with the other drivers that we had identified at the time, food prices coming down and all of those things. And that is important.
SARB Governor there, Lesetja Kganyago, just giving us some answers to a barrage of questions following his announcement that the repo rate remains unchanged at 8.25%. We do have some analysts who will be speaking to the decision and the various drivers of it after a short break.